Remember, even if you are investing in the best company in the wrong time, you will lose money. I think why stock market performed really well after Modi coming to power is because of the fact that they saw a political stability in the country. If the demand is very high, natural calamities are not there, market's going to be fantastic. See, all these days you might not have paid attention to these aspects. You might have thought, hey, why? How does it matter to me? Let me watch comedy, let me watch entertainment. But then now you need to pay attention to these aspects. If you want to be a pro in the stock market, if you want to have control over your investments, you should know these fundamentals which drives the market, right?
Hello again and welcome to the Freedom English channel. My name is Anupam Anand and today in this video we'll be talking about the stock market. Now, have you ever wondered about the factors that make the stock market go up and down? What causes the sudden jump and the sudden downfalls in the stock market every now and then? Today in this video we'll be learning about the actual factors that move the stock market. We have our expert and financial mentor CS Sudhir. He will explain how factors like supply and demand, economic indicators and investor sentiment influence the market. After watching this video, you will be having a better understanding of market trends and where you should be investing your money in stock market.
The stock market moves up and moves down based on various parameters. So it is important to note how it goes up, what brings it down. These things are very important. Many people, they try to invest in the stock market in the wrong time. Remember, even if you are investing in the best company in the wrong time, you will lose money. The company may be the best of all, but still, if you're investing in the wrong time, you will lose money. The company may not be so good, but if you're investing in the right time, you will make money. Hence, it is so important to know whether it is the right time or the wrong time. Whether the market is in an upward trend, downward trend. These things are important. So in this video, I'm going to show you step by step how to understand or what moves the stock market up or what moves it down. I'll show you one by one on screen so you can understand what moves it up, what moves it down, right? The number one parameter to be considered, the number one factor which pushes the market up or down is GDP, gross domestic product. I'm sure all of you know about it. So whenever we see this happening, GDP has gone up, GDP has gone down. During Prime Minister Manmohan Singh period, GDP growth was high, or when during Manmohan Singh period, GDP growth was low, or when Modi came in, GDP went up, or when Modi came in, GDP went down. All these political clashes. You would have also seen the GDP numbers being announced every quarter, and based on that, the stock market goes up or goes down, or Modi talking about $5 trillion GDP. What is it? It is gross domestic product. Basically, GDP represents the economy of the country. GDP is about the overall picture. So there is a set formula to calculate the GDP. So the GDP numbers are always announced by the government, and they basically talk about whether we have grown by 5% this quarter, 6% this quarter, 8% this quarter. They talk about it. And that really shows whether the GDP is moving in the right direction or not moving in the right direction. For example, today India's GDP is about $2.93 trillion. $1 trillion is equal to 75 lakh crores. 75 lakh crores. So $3 trillion is 225 lakh crores. Now, Modi's dream is to make it $5 trillion economy by 2025. But unfortunately, we got a shock and our economy is down by almost 8%, which means $3 trillion economy might have now become $2.7 trillion economy. So which means we have to again bounce back and we have to hit $5 trillion economy. Now, you may ask me, if we have to get to $5 trillion economy, what needs to be done? The domestic production has to increase, unemployment rate has to go down, exports have to increase, a lot of these things, imports might have to go down, various things basically, boost the GDP growth. So now, how does it impact the stock market? if the GDP growth is low, if it is going down, it means people don't have enough money. If people don't have money, then what happens? The consumption goes down. If consumption goes down, the companies who are supplying whatever people consume, their stock price will go down. Hence, the consumption plays a very important role and GDP plays a very important role. Whenever the GDP results are announced, stock market sometimes, if the GDP has gone down, automatically the stock price tumbles. The stock prices will go down, stock market goes down. Hence, GDP plays a very, very important role. So I want you to keep watching what's happening. So all these days you might have not noticed what is GDP or why it is important, but now you will have to start paying attention to GDP. The second thing I want to consider is monetary policy. What is monetary policy? I'm sure you know, Reserve Bank of India meets once in 3 months and they decide various monetary policy decisions. What are those? They decide the interest rate, they decide the repo rate, reverse repo rate, various things, right? So these things really matters. The monetary policy of the country really matters. So that is which talks about interest rate, inflation, all these things. So this is being controlled jointly by the finance ministry and by RBI. So they work together to make this happen. The monetary policy of the country really matters. So whenever Reserve Bank of India announces the monetary policy or the changes in the monetary policy, stock market very quickly reacts to it, because when the markets, when the interest rate goes down, stock market goes up. Reason, companies will now be able to borrow at a cheaper rate. When the interest rate goes up, stock market goes down, because the capital cost for companies will go up. Because when the capital cost goes up, their interest goes up, which means the profitability will go down. That's when the share price will go down. So like this, you need to look at various aspects. The monetary policy plays a very important role. This is being announced by RBI on a very regular basis. More importantly, inflation also. In case if RBI says, hey, the next 3 months the inflation is going to be high, automatically stock prices will go down. So because inflation also is going to affect the market badly. When the inflation is very high, markets will not really perform well. So that's also another important thing you need to consider.
Before we proceed, let me tell you, we have a detailed video about stock market in our Freedom app. Please make sure to download the Freedom app now and start learning from today. Become a better and smart investor.
The third is economic indicators. What are those economic indicators? Starting from unemployment, consumer price index, producer price index, purchasing managers index. Like this, there are various economic indicators which is being announced by the government on a regular basis. In fact, I'm sure you know about there's something called economic survey which government conducts every year, right? So these economic survey results are announced a day before the budget, central budget. So this economic survey talks about all these indicators. This also plays a very important role, because if the unemployment rate is very high in the country, automatically the share price will go down, the market will go down, because of the fact that if there is more unemployment, which means there is more the crisis in the country, which means the companies may not do well in the future. So for various reasons, economic indicators also play a very important role. So you should be watching these numbers as much as possible. Start reading these finance newspapers, start watching finance news channels, start using these apps which gives you this kind of information. That will also help you make right decisions when it comes to stock market. The fourth important factor which influences the market is political stability. What is political stability? I am sure you know, during this UPA government regime, so what used to happen, UPA government, UPA United Progressive Alliance was formed in partnership with various parties, various regional parties, including left, Communist Party and all. The Communist Party sometimes used to conduct a press conference and used to say, we are reconsidering our decision to support the government. Automatically stock market used to go down. Sometimes they used to come back and say, no, we are very good with government, we will continue, we will support the government's initiatives. Automatically stock market goes up. So if there is a political stability in the country, automatically stock markets start becoming very stable. If the political stability is not there, automatically it becomes very volatile. Reason is very simple. If the political stability is not there, the country's GDP growth goes down, all the socio-economic problems will increase. Because of that, the political stability really matters. I think why stock market performed really well after Modi coming to power is because of the fact that they saw a political stability in the country, which is also that's very important. The fifth point is foreign policy. What is foreign policy? Foreign policy means the relationship with with our neighboring countries or any other country in the world. For example, you would have seen the moment there is a trade war between India and the US, automatically the global market starts melting down. When there was a rumor that India-Iran war may start, automatically the market starts melting down. If there is a clash between, let's say, Trump and Putin from Russia, automatically markets start melting down. So these foreign policies, not just India, not just India's foreign policy with other foreign countries, even the global relationships between different countries also plays an important role. I'll tell you why that matters. For example, if Iran-US relationships goes bad, now what happens? Iran is a big supplier of petroleum products to India. Now that will be affected, which means our relationship with Iran will be affected because we can't afford to stay away from US. So a lot of these challenges will affect. So if China is affected or China-US relationship is affected, whole world will be affected. Hence these things needs to be considered. The foreign policy really matters. Now, so you need to continuously watch out for what is happening with India's foreign policy, how Indian government is looking at different countries across the world, and not just that, how other countries are looking at India, and also what is happening between the major economies of the world. If there is something wrong between some small countries in the world, you don't really have to worry. But then large countries, if they are fighting, if there's a clash between them, that will affect even our market. That needs to be considered. The sixth important factor is interest rate. Though I spoke about it briefly when I was talking about monetary policy, interest rate plays a very important role. See, interest rate plays a very important role for any companies because most of the companies who are listed in the stock market, you would have seen them having 50,000 crore debt, 1 lakh crore debt. Someone like Reliance Industries had almost 3 lakh crore debt, which they are trying to clear off by raising capital. But then there are many companies who have got huge amount of debt. So it is important to note what is the debt they have got. If the debt is high, interest rate is also high, which means the profitability will go down. There are companies with zero debt. Then you don't have to really worry about, see, you would have seen this happening in the stock market. Even when the interest rate goes up, those companies who have no debt, those companies' stock price won't be affected. But if the company has a huge amount of debt, just imagine a company which has 1 lakh crore rupee, debt, 1 lakh crore. If the interest rate goes up by 0.5%, that means this company will end up with paying 500 crore more interest every year, right? So that means to that extent that company's profits will go down. To that extent, the market capitalization also has to go down. That's why the stock price will go down. So interest rate plays a very important role. See, all these days you might not have paid attention to these aspects. You might have thought, hey, why? How does it matter to me? Let me watch comedy. Let me watch entertainment. Let me watch cinemas. Let me watch a song. But then now you need to pay attention to these aspects. If you want to be a pro in the stock market, if you want to have control over your investments, you should know these fundamentals which drives the market, right? The seventh one I want you to know is inflation. See, inflation is not just about the price of the product. We think, okay, hey, the price has gone up, which means it is it is affecting us, but whole economy will be affected. I'll tell you why. If the inflation goes up, automatically price of the goods and services will go up, which means the investments will go down, because that high inflation won't encourage investors to come here. It won't motivate them. They will not be, they will not be pleased, right? So that's why low inflation. You would have seen in the Raghuram Rajan period, he used to increase the interest rate quite often to ensure that inflation is under control. I mean, that's not a logic which I personally, appreciate. But then he used to do it, right? So what is most important here is inflation has to be in control. Maybe that way Modi is lucky because in the last whatever 5-6 years of his 6 years of his tenure, the inflation is pretty much under control, which is also a very important thing. And the eighth one is global markets. See, in India as a country, we are heavily dependent on global market. You can see that Nasdaq or Dow Jones, if the last trading day, yesterday, if the Dow Jones or Nasdaq has gone down, automatically the next trading session in India, you will see Sensex going down, Nifty going down. If Nasdaq or Dow Jones has gone up, automatically you will see the same reflecting in Sensex and Nifty. That's because we always borrow these cues from the stock global markets. If the global markets are performing well, I mean, something which happens in the US affects India largely, right? That's the problem in India. So that's why you need to understand how global markets affect. In fact, in 2008, whatever happened, all the crash, Sensex crashing from 22,000-23,000 to 18,500 level, it's because of global market crisis. It was not because of India. There hardly anything wrong happened in India. It was more or less, it was all about the crisis in America, right? So that's why it is important to start tracking global markets. It is good to know. I mean, it's good to, as soon as you wake up, please go back and check what happened in the global markets. How did they perform? Based on you can take a decision, okay, today is a bear market or a bull market. If the global market has gone up, you can say it's a bull market. If the global market has gone down, you can say it's a bear market, right? That's easy to make a decision. And the ninth one is supply and demand. That also plays a very important role. I'll tell you why. And the number of shares in a company won't increase every day. It is same unless until they decide to increase the shares. Hence, the supply and demand always plays a very important role, because if the supply goes up, demand is same, automatically price goes down, because these guys are very desperate to sell. The sellers, supply means what? More sellers are there than the buyers. Demand means what? There are more buyers than the sellers. If there are more buyers than the sellers, price goes up, because the buyers will demand. If there are more sellers than the buyers, sellers will get desperate and they will reduce their price, which means buyers will get it at a cheaper rate. So supply and demand plays a very important role. For every company stock, you can see what is the current volume, what is the buy calls, what is the sell calls. You can check everything. That is important. I'll anyway show you this practically while I'm explaining you this practically. And the 10th one is natural calamities, or things like the one we are facing today, the COVID-19. You know what happened when tsunami came, what happened when there was drought or flood. You know what happened in a terrorist attack in Mumbai. You know what happened when India-Pakistan war was there. You know what happened when Indira Gandhi was assassinated. You know what happened when Rajiv Gandhi was assassinated. You know what happened when there was a bomb attack in different places. These things really matter. Not just the natural calamities plus the terrorism, all these things really matters. What happened when the WTO tower was attacked? So all these things really matters a lot. Calamities, reason why calamities affects is because, see, these natural or man-made calamities will actually bring down the economic activity, will bring down the supply, will bring down the demand. That in turn will put the economic activity into halt. That in turn will spoil the overall ecosystem. That's why the stock prices goes down. Hence the indexes also goes down. So you need to take into consideration these 10 aspects, starting from the GDP, monetary policy, economic indicators, political stability, foreign policy, interest rates, inflation, global markets, supply and demand, and natural calamities. If you consider all these things and then make an investment, you'll know, okay, hey, market is doing good, market is doing bad. Let me give you an example. Let's say the markets are doing good. How do you know? For example, the GDP rates are going up, very good. Monetary policy is very favorable. RBI is supporting investors, borrowers, companies by reducing the interest rate. The repo rate is less, reverse repo rate is less. There is high liquidity in the market. Amazing. That's doing pretty good. Economic indicators also doing good. I mean, wherein it says unemployment is at all-time low. All that, those economic factors are doing good. Political stability is great. Every state, every the central government, everywhere we have political stability. There is no horse trade happening. There is no ambiguity on whether this government will survive or not. And the foreign policy is good, wherein when I say the fifth item is foreign policy, what is foreign policy? How is our relationship with our partners? The neighboring countries, different global players, all that really matters. So I want you to know that. And then the interest rate also matters, and the inflation matters, and the global markets, how they are doing good. So, that is, think about it. I mean, if the global markets are also doing pretty good, inflation is low, interest rate is also low, supply and demand, I mean, if the demand is very high, natural calamities are not there, market's going to be fantastic. It's a great, growth trend where everything is moving in the right trajectory. If anything, collapses, automatically market will start dancing. So you need to take into account all these aspects before investing.
Thank you for watching your video. Please make sure to drop your likes, your comments as well, and subscribe if you haven't yet. See you in the next one.